Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Blockbuster, Lehman Brothers, WeWork, names you definitely know. They bring up images of, well, massive corporate challenges, right? Some collapsed outright, others barely hung on. And then you think about JCPenney, Bed Bath & Beyond, Hertz, Cineworld. These aren't just headlines. They're actually really potent real-world case studies in corporate finance. Each one tells a story about what can go spectacularly wrong. So today we're doing a deep dive into the often pretty murky waters of corporate bankruptcy and insolvency. Our mission, to get beyond the surface level and pull out the really crucial lessons. For finance professionals, yes, but honestly, for anyone curious about how companies succeed or, fail.
That's right. We'll be looking at those subtle early warning signs, the ones that often get missed in the day-to-day, and the key financial ratios that basically scream distress. And maybe most importantly, how the finance function itself, whether you're in FP&A, treasury, corporate development, how that becomes the absolute epicenter when things go south.
Exactly. And this deep dive, it pulls together insights from top financial analysis resources. Think of it as a shortcut to understanding these really complex situations. So what does this all mean for you, for your role, or even just how you read the business news? Let's unpack this. Okay, first things first, maybe the most fundamental question. What does it actually mean for a company to be insolvent? It sounds simple, but there's a distinction here that's pretty critical, isn't there?
Yeah, it's a great place to start because we all kind of get running out of money, but for finance pros, you really need to separate the two core types. So fundamentally, a company's insolvent when it just cannot meet its financial obligations. And like you said, it's not just defaulting on a loan, it could be failing to pay suppliers. Or, critically, running out of that essential working capital just to keep operations going. And this failure to pay shows up in two main ways. First, you've got balance sheet insolvency. Think of this as a paper problem. It's when a company's total liabilities, everything it owes, add up to more than its total assets, everything it owns. So on paper, it's underwater, even if there's, some cash still there. Then second, there's cash flow insolvency. This is the immediate cash problem. The company might look okay on the balance sheet, maybe, but it doesn't have the actual liquid cash to pay bills when they're due. It's like having a valuable house but no cash for groceries or the electricity bill.
Okay, so it's rarely just one or the other in a big collapse. It sounds like the real danger is how they interact. Like the paper problem eventually causes a cash crisis.
Exactly. That's usually how it plays out in major failures. It's a painful combination. The balance sheet weakens, maybe they breach some loan covenants, and then suddenly the cash just dries up. Nobody wants to lend. Suppliers demand cash up front. It spirals.
Right, a downward spiral. So knowing that, if you're a finance professional, what are those specific red flags, the things you should be constantly watching for, maybe things that get overlooked?
Good question. There are definitely signals. Look for declining gross margins consistently, quarter after quarter. That's often the first hairline crack. Then keep an eye on rising debt-to-equity ratios. That shows the company's leaning more and more on borrowing. And the interest coverage ratio, you really want to watch that one. If it falls below, say, 1.5 times earnings before interest and tax, well, that's a serious alarm bell ringing. It means they're struggling just to cover interest payments. Beyond the big ratios, look at operational things, too. Are they delaying payments to vendors? That's a classic sign. Or, conversely, are suppliers tightening credit terms, demanding faster payment? That shows they're getting nervous. Also, big, unexplained swings in cash flow. Need to dig into those. And maybe more subtly, watch management. Are they constantly overpromising? Pivoting strategy without a clear why? That can signal a lack of real confidence underneath.
That's where it gets really interesting and actionable. Because if you're seeing your own financial models constantly needing, let's say, adjustments to hit targets, or board meetings feel really tense, or those cash flow forecasts just keep missing, those aren't minor issues. They're symptoms, right? Financial stress signal.
Absolutely. They're concrete symptoms that something deeper is probably wrong. It takes insight and sometimes courage to connect those dots. And for people in FP&A, you're often in the best position. You can link those operational shifts directly to the financial impact. You have that early visibility. The challenge, though, isn't just seeing the signals. It's making sure they get elevated, that leadership understands the implications before it's genuinely too late. And yeah, bringing bad news takes guts.
Definitely. So, okay, we know the warning signs. How does this actually play out? Let's look at some of those big examples, not just cautionary tales, but real-world illustrations.
Yeah, let's take Lehman Brothers back in 2008. We all remember it, but it wasn't just about bad mortgage bets. Fundamentally, it was a story of just staggering unchecked leverage. At its peak, their leverage ratio was over 30-1. Think about that. It means even a tiny dip in their asset values could completely wipe out their equity.
30-1. It's hard to even picture.
It is. So when the market liquidity just vanished, they couldn't refinance, they couldn't roll over their debt, and boom, bankruptcy. Over $600 billion in assets, the biggest in U.S. history. The lesson. Leverage cuts both ways, hard. Or look at Toys R Us, filing in 2017. Yes, e-commerce hurt them, obviously, but the root cause went back to a 2005 private equity buyout that loaded them with over $5 billion in debt. So all their free cash flow, everything they made, was just going to service that debt. There was nothing left to invest in modernizing stores, building a decent online platform.
Which, as you said earlier, is critical in retail. No room to adapt.
Exactly. A classic case of debt suffocating the ability to transform. And then WeWork. Filed in 2023, but the problems were brewing for years, weren't they?
Oh, yeah. The writing was on the wall for a long time.
Massive lease obligations they couldn't escape, weak unit economics, meaning each location wasn't really profitable on its own, and just an unsustainable cash burn rate, burning through billions. The big lesson from WeWork. Growth for growth's sake, without sound economics underneath. That's not a strategy. It's often just a ticking time bomb. Finance needed to challenge those assumptions, even when the hype was deafening and valuations were through the roof.
And it's not just those three. You see similar threads in others, like JCPenney in 2020. High debt, sure, but also just failing to adapt to how people shop now. Slow on e-commerce, confusing pivots.
Alienated their base sometimes.
Yeah, and Bed Bath & Beyond just last year, again, leverage, overexpansion, kind of a messy strategy, poor capital allocation.
Right.
It all adds up. Hurts. In 2020, the pandemic travel collapse was the trigger, but they already had issues with fleet management and heavy debt. The shock just exposed the weaknesses.
Right. The pandemic accelerated things for many.
In Cineworld in 2022. Huge chain, but pandemic losses combined with all the debt from buying Regal cinemas. It was just too much. Shows the danger of big acquisitions right before a downturn.
It's true, but it's also worth looking at the flip side quickly. Like Delta Airlines during COVID, they avoided insolvency. How?
Wow.
By proactively raising over $16 billion, debt and equity. And interestingly, a lot of that was backed by their loyalty program, SkyMiles. Shows some creative financial thinking can make a huge difference.
That's a great point. Necessity is the mother of invention, even in finance. Okay, so let's say the worst happens. A company hits distress. What goes on inside the finance department then? You called it the war room.
It really becomes that. The CFO's office turns into the absolute nerve center. Functions like FP&A, Treasury, Investor Relations. They're suddenly the core crisis response team, working insane hours under incredible pressure.
I can only imagine. It must be more than just crunching numbers 24/7. What are the biggest, maybe unexpected pressures they face?
Oh, definitely. The emotional toll is huge. You're dealing with potential job losses, immense uncertainty, the pressure from lenders, shareholders, the board, the media. It's relentless. And you're making massive decisions, often with incomplete information. It's high-stakes poker. But each function has a critical role. FP&A. They're building and rebuilding forecasts constantly, running brutal scenario models. What happens if sales drop another 10%? How many days of cash do we actually have left? That cash runway analysis is everything. Treasury is managing the day-to-day cash, making sure they don't accidentally trip any debt covenants, which can be incredibly complex. And they're in those really tense talks with lenders.
Trying to negotiate breathing room.
Exactly. While investor relations is on the front lines, communicating with shareholders, creditors, the press, trying to manage the narrative, explain the turnaround plan, often when things look pretty bleak. It's a tough job. And then corporate development or strategy folks are looking at the hard choices. What assets can we sell quickly? Are there any desperate M&A options? Or designing the big restructuring plan itself.
Wow. Across all those roles, it sounds like there's one single overriding priority. Just buy time.
Precisely.
Yeah.
That's the name of the game in the early stages. Every decision, drawing down a credit line, pushing out supplier payments, freezing hiring, delaying capital projects, it's all focused on one thing. Extending that financial runway, giving the company more time, more options, even if those options are painful ones down the road. Preserve optionality.
Okay, so time is critical.
Yeah.
And managing that requires laser focus on the numbers. We touched on some, but what are the absolute non-negotiable KPIs, the ones every finance pro needs to watch? crisis or no crisis.
Right. These are your dashboard indicators, always on. First, operating cash flow, OCF. Is the core business actually generating cash consistently? It's the absolute lifeblood. Forget profit for a second. Is cash coming in? Second, that interest coverage ratio we mentioned, EBIT divided by interest expense. You really want that comfortably above 1.5x, ideally much higher in healthy times. If it dips near or below 1x, you're in deep, deep trouble. You can't even cover your interest payments from operations.
That sounds like a flashing red light.
It is. Third, the current ratio. Current assets divided by current liabilities. Simple, but tells you about short-term liquidity. Less than 1. That signals potential immediate cash strain. Can you pay your bills coming due soon? Then there's the Altman Z-score. It's a bit more complex, combines several ratios, profitability, leverage, liquidity, solvency, activity into a single score. It's specifically designed to predict the likelihood of bankruptcy. A very powerful tool if used correctly.
Sort of an overall financial health score.
Yeah, that's a good way to think about it. And finally, free cash flow to firm, FCFF. After all investments, is the company generating cash available to all its investors, debt, and equity holders, or is it burning cash overall?
It really seems clear then. A healthy balance sheet might not save you from a black swan event like a pandemic.
Right, like Hertz.
But a fragile one almost guarantees you'll be in trouble when shocks hit. The absence of red flags isn't a guarantee, but their presence, that's a siren.
Well said.
So bring it all together for everyone listening, whether you're deep in corporate finance or just trying to understand the business world better. What are the big strategic takeaways here?
Okay, a few key things for finance professionals, especially mid-career. 1, always watch the fundamentals. Don't get blinded by market hype or just chasing growth. Profitability, cash flow, they still matter most. 2, treat liquidity like the critical KPI it is. It's not just a line item, it's the oxygen supply. Monitor it relentlessly. 3, and this is maybe the hardest, develop the courage to speak up. If assumptions look shaky, if a plan feels unrealistic, challenge it. Constructively, professionally, but challenge it. It's your job.
That takes real backbone, especially when things seem rosy on the surface.
It does. 4th, know how to build and interpret crisis models. Understand scenario planning. Track that cash runway meticulously. That skill becomes invaluable when things get tough. And finally, 5th, understand how all the functions have to work together in a crisis or turnaround. Finance, operations, legal, HR, it has to be seamless. It's truly an all-hands-on-deck situation, no silos.
And maybe one final thought. Not every failure is a sudden crash. Many companies, maybe most, unravel slowly, over quarters, even years. The real skill, the real value you can bring is spotting those early subtle signals, understanding how they connect, and having the foresight and courage to raise the flag before that downward spiral really takes hold.
Absolutely. Thanks for diving deep with us today. Hopefully these insights give you a clearer lens to view corporate health and distress.
Yeah, whether you're looking at debt ratios, modeling turnarounds, or maybe just noticing those early warnings in your own company or industry, your perspective matters. Your insight is crucial. So stay alert, stay strategic.
Until next time, keep learning and keep leading in finance.
So think about it. After hearing all this, what stands out most to you? Which red flags seem most critical? And how might you apply some of this thinking to better understand the companies around you? Maybe you'll spot something others miss.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.